Right, I think we can make a start. Good morning, everyone. Welcome to the April TSP webinar. We've got a packed agenda today, so if you go on to the next slide, I'll introduce you to the speakers. So for first up is the usual direct tax news updates, which Jeff's going to do from a direct tax point of view, and Rob's going to cover from a VAT perspective. You must have spoke to both of them before. They've been around in the tax line for ages. And then Chris is going to talk through about corporate restructuring and intra-group transfers of trade and assets. He does a lot of that. He is BDO's demerger champion and an expert on reorganizations. And also Rob Woodward, who you may have spoke to on employment tax matters. He's going to talk through umbrella companies, which is a very topical topic. So if you go on to the next slide, that is the agenda, which we've just covered right now. So if you go on to the next slide, I think Jeff can start with the direct tax news items.
Yeah, good morning, everybody. I'm Jeff Webber. I'm one of the tax line consultants. I'm dealing with the direct tax news update items. So can we have the next slide, please? It's been relatively quiet as far as new tax issues are concerned, because there was very little actual action in the spring statement. But what was important is that as well as the economic forecasts and various welfare changes, there were quite a few tax-related consultative documents on various topics. And I'm just going to go through a few of them on a very high level, just so that everyone is updated. First bullet concerns R&D tax reliefs. This has been a very hot topic now for a couple of years, with the revenue hugely tightening up their audit of R&D claims, and there's now a requirement to notify in advance. The consultative document looks at the concept of advance clearance, and a decision is going to be made to the extent that advance clearance is either going to be voluntary or mandatory or a combination of both. And the consultative document also looks into or mentions the possibility of at least some of these advance clearances being paid for, which would be an innovation. We've just never had paid for clearance applications in the UK, unlike several other countries. So the outcome of the conduct will be very interesting, and watch this space. Talking of advanced clearances, a completely new concept for which a conduct was published was the idea of advanced clearances for very large complex projects. By these we mean multi-million or possibly even billion projects, often with overseas investment. The idea being that we're going to improve investment into the UK if overseas and UK investors can have certainty as to what the tax implications will be. It won't affect many people because it's only going to be for the very largest entities. Again, the question has arisen of whether these clearances could perhaps be paid for. This is all in the consultative document. It's an interesting concept, and it's a new concept for the UK. Moving on now to the third bullet point, which is the use of advanced pricing agreements to obtain confirmation of transfer pricing treatment of cost contribution agreements. These are complex agreements, normally dealing with how the costs are split within a group and the transfer pricing implications of them. Again, hopefully this will be these agreements will be accepted by HMRC or looked at by HMRC free of charge. But you can see which way the tide is running. the revenue seemed to be moving towards the concept of paid for clearances. So again, watch this space. Moving on, one of the consultative documents looked at tax avoidance scheme promoters. HMRC is very concerned that even with the existing DOTAS legislation and stop notices and so on, there are avoidance scheme promoters who are ignoring them and hoping HMRC won't catch up with them. So they're looking at beefing up that legislation, and also the conduct looked at whether the HMRC could take action against legal professionals involved, for example, removing legal privilege in some cases. Again, this would be an innovation, and it remains to be seen what the outcome will be. Finally, a little bit of good news. A new type of stock market, I suppose you'd call it, or share exchange is proposed, called Pisces, which will be a sort of over-the-counter market for private shares. And amongst other tax proposals, it's proposed that transfers of shares in these private companies within Pisces will be free of stamp duty and SDRT, rather like the exemption for shares listed on AIM. So that's quite helpful. That's all I've got to say about the consultative documents. I would add, though, that some of them are of wide application, and if any of them affect your clients, it's a good idea to have a look at them, and if necessary, contact your regulators or institutions, because they will be replying to the condocs. And if you got anything to say, it's good to say it through your institutions. Moving on now, I got one or two other things to cover. Firstly, I just thought I'd mention what's happening on IR35. HMRC has been pretty busy. There's a steady stream of IR35 cases. Not all are won by the revenue, but I think the revenue have been quite successful recently in a line of cases involving people such as television sports pundits. The latest one concerns the former footballer Phil Thompson, which HMRC succeeded in convincing the tribunal that his contract with Sky was caught by IR35. So if you've got any TV presenters or TV sports pundits, you should be aware of the latest line of cases and the hard line taken by HMRC. Next slide, please. Just a very brief reminder here, we're halfway through April, and if you got client companies who own any properties within a company valued more than £500,000 and therefore within ATED, the ATED returns or relief claims, if appropriate, for 25-26 must be filed and ATED paid by the end of this month. So you've got about 2 weeks to do this. Next point I'm mentioning is the latest HMRC Spotlight 68. There is apparently a marketed avoidance scheme, which I must admit I've not come across personally, which essentially dresses up profit extraction as advertising and marketing expenditure. A company will be set up to offer what is described as marketing and advertising services at what seems like a highly exorbitant price, and as part of the scheme, the providers will actually return about 80% of it to the directors of the client company as loyalty scheme points on a card. I mean, this smacks more of evasion than avoidance. It reminds me of deals struck for infrastructure with third world countries, where the politicians there agree an exorbitant price with the first world providers, and the first world providers then give them a kickback. This just reminds me of that evasion. So strongly advise to steer very well clear of Spotlight 68 type schemes. And I think that's it. I've mentioned IR35 already. Next slide, please. I'll hand you over to my VAT colleague.
Well, good morning, everybody. So three things from me on the indirect tax side. So one thing, the first thing is one that everyone's been talking about. It's been across the news now for a few weeks. And this is the announced tariffs by President Trump on all goods entering to or quite a few goods entering the USA. And this is a moving feast. So it is changing almost on a daily basis. Now, we're not going to comment on the political nature because that's not really what we're here to do, but just comment on what exactly has been put in place. So, what President Trump has done is basically said we've got a method of calculation, which is to take US goods, well, the trade deficit for US goods with a particular country, divide it by the total goods imports, then divide that by two. So, if you may have heard the news that he's put a tariff on the herd of McDonald Islands, which you may have seen is entirely inhabited by penguins. So, I'm not entirely sure how Trump's calculation works out, so it must be penguin bars. But on the UK, it's a 10% on all goods. EU is 34% on all goods, but there's also at least a 25% tariff on all imports of steel and new cars. Now, the biggest one that you may have seen, and this is the way it's movable feast, because this has already changed since the slide was drafted, is that on goods with Chinese origin, the tariff is now 145%. And the other thing that's, I don't think necessarily the BBC numbers have picked up on this, but the $800 de minimis for importing goods from China and Hong Kong is going to be removed from the 2nd of May. Now, this comes as a big problem for retailers. So if you've got retail clients that buying goods from China and sell them on from the UK potentially, this is going to be a big issue. Because it doesn't matter where it's imported from. What the US will be looking at is the origin of the goods. So the goods with Chinese and Hong Kong origin, and a survey of retailers basically said that the average basket is less than $800 when purchased in the USA. This means they're going to be hit by this massive tariff. The other thing that the BBC reported on last week as well, there's an economist, and this is why I don't take bad advice from economists, who said, "Oh, what you should do is move the goods via Northern EU goods via Northern Ireland, and to get your 10% tariff," which it doesn't work because the origin will still be the EU. So the big things with this is to make sure if you have got clients in the retail sector all going to be affected by this, is make sure they know where the origin of the goods is. And you may also need to look at supply chains as well, just to work out how the tariffs are going to affect your clients. So say it's a moving feast, it could be it all change again by this time next week, but it's definitely something to be aware of. Next thing is a spring statement. Jeff's already mentioned the direct tax. From indirect tax perspective, that is very, very quiet. The main thing is that the changing the provision on late payment penalties for VAT. So just a reminder of how this works. If you pay your VAT liability up to 15 days late, there is no penalty. But obviously, interest will be charged. And remember, the interest rate has just gone up, late payment interest rate has just gone up to 8.5%. If you pay between 16 and 30 days late, you then get the first payment penalty, which was 2%, is now 3%. And if you pay over 31 days late, you get the second payment penalty, which is another 3%. But also now, the additional penalty, which was 4% per annum, is now 10% per annum. So you work out on a daily basis, works out as a fraction of a year of the day on a daily basis. But it's just a reminder to submit your VAT returns and pay the VAT liability on time because the penalties have gone up. Next slide, please. And last thing I just want to mention is the bulk services case. So this is a case involving a private hire company. And it's a company that actually operates the base that the drivers pay into. And it's all to do with the tour operators margin scheme. Now you make tour, even for VAT specialists like me, when you see the toll operators margin scheme, or TOMs, you tend to run a mile. But this is all to do with the fact that Bolt were using, trying to argue that TOMs apply to the services they were supplying as principal. This is where they contract directly with the person who wants to have the private hire vehicle, because they were buying in services from their drivers and then selling them on without materially altering them. And this is why they said TOMs applies. Remember, TOMs is to do with travel. So you buy in travel services that you don't materially alter. That means you don't change them significantly to make them something else. And if it's not, and also ignores anything that you in-house, any in-house, what they call in-house supplies. That's where your own supplies, or your own assets, etc., used to make the supplies. And in-house and materially altered supplies fall outside of TOMs. So HMRC had argued in the first tier tribunal, and now in the upper tribunal, that all the supplies that Bolt were making were either in-house supplies because of their drivers, or they were materially altered. And the upper tribunal has now agreed with the first tier tribunal that TOMs does apply. So, and basically means that when Bolt account for the VAT, rather than just accounting for output VAT and the whole amount that they've charged to the client, they only have to account for VAT on the margin between what they buy in from the driver and what they sell on to the customer. Excuse me. Now, it's going to have an impact on private hire, and certainly because it's an upper tribunal case now, so it is binding on everyone below. It basically means that if you have got private hire companies that are supplying as principals, and that's not where the drivers buy it, sell the services. This is where you have the contract with the ultimate owner of the private hire company, or the ultimate private hire company. This could now be, in theory, it's subject to TOMs. Now, there's obviously there are other things with this. Remember, the Uber case is going through regarding employment status. I'm not going to comment on that, but obviously that's going to affect VAT potentially as well, and that can make it back into in-house supplies. But will this make the UK government now get rid of TOMs? Because TOMs is a European law concept. The UK government chose to keep it, but obviously now with cases like this, there's other cases as well where HMRC have lost, where they didn't want TOMs to apply, that TOMs does apply. So they may end up getting rid of TOMs altogether, possibly. Who knows? We'll find out. We'll see what happens in the next few years. Next slide, please, and back to Sadiq.
Thanks, Rob. And before Rob Woodward gives a talk on umbrella companies, just want to say, please do type in questions as you go along if you have any questions, and we'll cover it at the end of the topic. So thanks, and over to Rob.
Good morning, everyone. So I'm Rob Woodward. I specialise in employment taxes, in particular off-payroll workers and engagement with agencies. And obviously matters including umbrella companies is very topical for me. So go to the next slide, please. So just as a background and kind of building on one of the comments that Jeff made around sort of consultation, this has been sort of rumbling on in the background. There has been a series of consultations around the umbrella company and regulation of umbrella company. And further to that is also been a number of legislative changes. So in respect of umbrella companies, including changes to the agency workers regulations, travel and subsistence rules in 2016, bits around sort of the Taylor review and employment status, and of course also the IR35 reforms. Umbrella companies are obviously topical at the moment, and off-payroll working is topical at the moment, not only, again, because Jeff mentioned around the IR35 cases, but also businesses looking at mitigating the impact of cost increases for employees. And in particular, since the start of this month, the increase in employers' national insurance to 15%, the threshold at which employers' national insurance has decreased to £5,000 per year, and also an increase in minimum wage above inflation. So that there are cost pressures, and there was the temptation to try and mitigate the costs. So, but obviously the government's mindful of that, and so has been looking at what's been going on in the umbrella market, especially since the IR35 reforms, because there's been a lot of sort of, what if you just move everything to an umbrella company? then that's fine. It absorbs the risk, which it doesn't, and this is obviously seeking to try and address that. So there was a call for evidence a couple of years ago around sort of umbrella companies, how they're used, what's their purpose. This was then followed up with a series of questions around sort of what are the issues that are coming through, what are the points, and that was collated into a report that was issued out earlier this year. And the key themes from that, and it's worth mentioning at this point that it focused on both employment tax, which I'll cover now, and also employment law, which is outside the scope of the stuff that we would look at. But it's worth bearing in mind that there are two sides to it. The key themes, as I put up on the screen there, they show that there's a lack of transparency in umbrella companies, and part of that is a recognition of the fact that there is no term for umbrella company, no legislative term for umbrella company. It can mean different things to different people. Some people look at umbrella company and think it's akin to effectively an employment agency. So they're employing the workers, they're paying PAYE, they're treating them as employees for tax and legal purposes. Other people might look at an umbrella company, and this is still valid definition at the moment because there is no legally binding definition. The umbrella company could just be a payroll operator. So they're not treating the workers as employees, but they're paying them through the payroll, they're operating PAYE. Or it could be that an umbrella company could just be a payment processor. So they're not operating payroll, they're not operating PAYE, the workers aren't being treated as employees, so are accumulating no employment rights. So that is part of the problem, and that's leading then to a lack of transparency. Again, the government is then concerned around sort of that there's an exploitation because of that lack of transparency. And as I say, that's both in terms of the employment rights, which we won't cover here, and also around the tax side of things, especially where there might be fraudulent or non-compliance or schemes involved, such as mini umbrella companies. Jeff's already mentioned about spotlights, and I'll come on to talk about HMRC activities, but quite a lot of them, the most recent ones, have been around the use of umbrella companies. Within the follow-up to the consultation, there are likely to be some changes, and I'll talk about that in a second. What we don't know at this stage is exactly what form those changes are going to take place. What we do know is there's going to be a legislative definition of umbrella company, and that's going to be for employment and for tax purposes, but that hasn't been confirmed exactly with the form of that. There's an employment rights bill going through Parliament at the moment, but we were still waiting for further guidance. Following from that will be the fact there'll be defined rights for employment for umbrella company workers, so they'll be legally entitled to certain rights. What rights they'll be, again, is outside the scope of what we'll be discussing, but it's worth bearing in mind that the anticipation is the umbrella company would be responsible for making sure the employees have rights, employment rights. From a tax point of view, that will also take into account things like minimum wage, entitlement to holiday pay, pension contributions, that sort of stuff. And there would also be enforcement of those rights as well by a third party. A lot of employment rights at the moment is enforced by the individuals, but there's going to be greater powers to things like the Gangmaster Labour Authority to be able to enforce those. There is a director of labour market enforcement. There are obviously going to be more powers to that. There'll also be some powers transferred over from HMRC as well in terms of policing that. We may well see some transfer of HMRC staff to this enforcement authority. And the final point, and the bit that I'm going to be focusing on here, is around the comment that the agencies are going to be liable for PAYE. So we can move on to the next slide, please. The bit that is the unknown is exactly what that will mean in terms of the agency being liable for PAYE and national insurance. There's a general thought that the umbrella companies might be the more dodgy end of it, but the agencies, as having the primary relationship with the business that are benefiting from the workers' services, they are larger, will have deeper pockets, but also if they have more skin in the game, then they're going to want to make sure that they're going to be an element of policing as well. What we know at this stage is that these agency liabilities will be effective from the 6th of April 2026. So we've got just under a year before they become effective. The draft legislation and the guidance hasn't been published, so some of this, what we're talking about, is a bit speculative based on what the potential scenarios it could be. But as you said, one thing we do know is that the agency will be responsible for PAYE and national insurance. Now, it's worth at this stage just taking a step back to considering that most agencies don't run their own payrolls for the agency staff. The usual business model is that the agency will have the relationship with the end clients. So a construction business, for example, construction business speaks to the agency. The agency says, "We'll promise you 50 labourers to work on this project." The agency themselves won't be the employer or the provider of the workers. They'll go to an umbrella company, who would then be paying the workers. The workers will be engaged with their payments, and their engagement will be with the umbrella company. The umbrella company then receive their fee from the agency. The umbrella company then pays the worker. The two options that are potentially liable is either the agency runs the payroll, so it cuts out the umbrella company for that, or the umbrella company still runs the payroll, but the agency has a responsibility and a liability if the umbrella company fails to operate that. So effectively a transfer of debt provision. If it's the case that the agency has to run the payroll, then clearly that's going to be an additional cost to them. And potentially it could also mean the end of the umbrella companies. So if you're speaking to clients who are engaging with agencies, or the employers who are engaging with agencies, there's a warning to them that either their agency margin is going to, the fees they're going to have to pay to the agency are either going to go up, or there's going to be possibly a short-term shortage of workers because the agencies are having to onboard the workers. So there's a risk there in terms of the supply of the workers. If instead there is a transfer of debt so that the agency is responsible for the PAYE if he's not paid, but ultimately the umbrella company is still paying the worker, then for the agency there is obviously a cost obligation to monitoring whether the umbrella company is liable, has been doing the right thing, and also ensuring that their supply chain is correct, which is obviously a cost matter, as well as a time and expense, and also that will then be passed on to those costs will probably be passed on to the umbrella company. So if some of your clients are umbrella companies, there's going to be a cost implications to them as well, because the agency is going to have a greater cost. They're going to take a greater share. Ultimately, this means that there's going to be additional cost pressures on the agencies, on the umbrella companies, or both. And that's either going to go one of two ways. It's either going to be passed up ultimately to the end of the chain to the company that's benefiting from the worker, so the end client, or there's going to be cost implications and margin cuts for agencies, for umbrella companies, or both. So if you're advising umbrella companies or agencies, then there's going to be cost implications for them as well. So either way, there's going to be cost pressures. Ultimately, and the aim of this is that this will be the end of non-compliant umbrella companies. One of the comments within the consultation was around whether umbrella companies would stop completely. The government hasn't said anything on those lines, but obviously they're clearly targeting the non-compliant umbrella companies, and with good reason. Can we go on to the next slide, please? So I just wanted to sort of round up sort of HMRC activity, and also sort of how this will impact on the day-to-day work, and what we're likely to see, and also what you should be advising your clients, whether they are agencies, umbrella companies, or indeed they're engaging with agencies and umbrella companies, which both your businesses will do. So there's been a significant amount of HMRC activity around that. There's been a lot of guidance been published recently. And that includes the guidance for compliance. I've given all the links there, so I'm not going to go through all of them, but clearly there's these are all within the past 5 or 6 months that the revenue have issued these. So there's been a lot of guidance around what the umbrella company should be doing, what a good umbrella company looks like, what you should be doing if you're engaging with an umbrella company, what the tests you should be checking for, what are the things that the revenue are looking for. Focusing on workers, how would you work out are you being paid the right amount, and you receiving the right amount? Is the right amount of tax being paid? Is there fraud in the supply chain? What's the telltale signs for that? And that last bit on the fraud is both from an employment tax and also from a VAT point of view. So there's been a lot of revenue activity, a lot of guidance, what the revenue are anticipating, what they anticipate good and what they expect good to look like. And we're seeing that manifesting itself in the inquiries. So I mentioned previously around the spotlights. There's been a number of spotlights issued around sort of use of umbrella companies, in particular things like loan schemes, which are called by disguised remuneration, arrangements with pensions or annuities where contractors are being paid a small amount and they're receiving the rest as an annuity, off payroll payments, mini umbrella companies where they're set up to, rather than having one large organisation, they're set up with lots of small organisations so that they can benefit from the VAT flat rate scheme, and also each claim the employment allowance is an artificial division of an agency to smaller umbrella companies, which doesn't work, but there's been people who've been trying to do that, and a lot of this is set up and then the revenue paying catch up. So a lot of this is trying to get these before they become prevalent or before they really become established. There's also been attacks from the revenue around the use of travel and subsistence. So even though the travel and subsistence rules changed in 2016, there's still a number of cases rumbling on. So you may see that clients being affected by that in terms of an agency is going through an inquiry and suddenly they are increased cost, or the agency collapses because some of these have significant amounts of money. The main pay case, for example, the tax and national insurance stake was in the millions. There's also been insolvency cases against umbrella company directors. So the case reference there, there were workers who were supplying services to the NHS, and the loss of tax and national insurance was over £7 million, and the revenue have been pursuing the directors personally because they tried to effectively phoenix the company. So there's been a lot of angles that people have been the revenue and also other government agencies are looking at from umbrella companies. So they said there's a lot of activity in this area, and so the key message and the takeaway is whether you're engaging the umbrella companies or engage with agencies, obviously be aware of the new rules. But for everyone else, so if your clients are engaging with agencies and umbrella companies, the key points around is understanding who is in that labour supply chain. Is there any non-compliant aspects to that? Because there could be a transfer of debt, there could be a transfer of liability coming in. There is also potentially around the employment rights as well. So, which again, we're not going to cover, but there could be sort of becoming more responsible for who's in workers' rights further down the labour supply chain. And ultimately, shouldn't really come as a surprise to anyone. So whilst the non-compliant structures are there and they've been known about for a while, the transfer of debts, if the POA transfer of debts, will only just build on what the obligations need to know who's in the labour supply chain at the moment, because ultimately that is responsibility. Knowing who you're engaging with, who's being paid, where the money's going, is an obligation under the corporate criminal offence to prevent the facilitation of tax evasion. So these are just more strengthening it. So this is not a revolution. This is an evolution of matters. But obviously there is more things to consider. So make sure you're mindful of it. Next slide, please. I think there's just questions after that. So if anyone has any questions now, I'm happy to pick those up. Otherwise, we can pick those up at the end.
Thanks, Rob. It's very useful. We just got the one question. It's about workers' rights. It's not really a tax question, but it says many umbrella companies have poor terms, such as zero notice, which begs the question: how are workers' rights protected?
I'm going to sort of slightly dodge that question because it's an employment law question. But
Yes.
from the I did mention there's going to be there's talk about an enforcement, labour market enforcement. Again, that's so that there will be something around those. But as I say, it's ultimately an employment law question, so we can't really answer that.
Absolutely. Yep. Cheers, Rob. I think that's the last question, so we'll let you go.
Yeah, thank you.
Cheers. And if you go on to the next slide, it's the last presentation, which is Chris.
Thank you very much. As Jeff mentioned, as well as being a tax line consultant, I'm also the firm's what we call a tax champion in all things demergers, corporate restructuring, and transaction securities. So when we think about what topics to do, this is something I've been doing a lot of recently and talking to people internally and externally around. It's actually transferring assets, transferring a trade and assets from one group company to another group company. Often we do this as part of a wider transaction, so it might be the middle step of a demerger. So we'll be talking about it in the slightly wider context as well, but primarily I'm just simply talking about transferring trade from company A to company B, where they're both in the same group. Next slide, please. Right, start off on the right hand side. Normally we see these things as being carried out through various legal mechanisms. Commonly distribution of specie, so if it can go up the chain, that's quite a useful thing, providing you've got the reserves to do it. But it means that there's no consideration, so things like stamp duty and SDLT aren't in point. Another one could be if we're going sideways, for example, we might sell the debt, we might sell the assets across for net book value or market value and leave the debt outstanding, and then release the debt, and the releasing the debt would then constitute a distribution. So again, you need reserves, but you haven't got the reserves, you can leave the debt in place. And the other one, when we're doing it downwards, it might be we transfer it down for consideration being an issue of shares. So there's lots of different ways of doing it, and normally we leave it to the lawyers to decide what's appropriate, but it often does turn on the what reserves are available within a company. Now, when we're transferring a trade, the key point to remember is that the trade consists of all of the assets of that trade. And those assets are going to be of lots of different types. So technically, you have to look at each type of asset and consider the tax analysis separately for each one. So that's what I'm going to run through here, some of the main ones. I mean, when you're giving the tax advice at the start, you might just be talking about the main things. If the main asset is property, you'll only really be talking about capital gains and SDLT, because that's the big things that affect the decision making. But then when you come to the tax return, you've got to look at everything. So you will need to look at everything at some point. Right, next slide, please. But let's start off with, as I said, sometimes it's done by distribution. Just a couple of quick points here. The first thing is, obviously, distributions are normally a distribution from one company to another within the group. A company receiving a distribution from another company is normally exempt of corporation tax, so it's not taxed. There is, though, it is worth noting there's a not for tax avoidance provision in Part 9A. So we have actually worked out ways of putting in clearances on let's say the corporate transactions and securities rules, so get the revenue to agree there's no tax avoidance where there is a very large number involved. We've done that a few times, but just something to bear in mind. The other thing the other sort of general point I'll put at the front here is around losses. Where a trade is transferred from company A to company B, and there's effectively no major change in the ownership of the trade because those two companies are owned by the same people, in this case part of the group, so they are. Then special rules are included in CTA 2010 that govern all of this. Section 944 specifically says that in those situations, any historic losses on the trade are transferred over to the successor, who will then carry on claiming them in their own name. Now, in the old days, you may remember there was pre-2017, there was a tax case called Leak, which told us that we had to streamline losses because pre-2017 losses could only be relieved against profits of the same trade. Since the 2017 loss relief rules, carry forward loss relief rules have changed, and they can now be relieved against everything. You no longer need to worry about loss streaming for post 2017 losses, but you still do for pre 2017. Right, next slide, please. Right, okay, I'm going to basically go through and imagine the balance sheet and just go through all of the various bits and pieces and talk about the different types of assets. So first one, capital gains. Now, I think most people are aware that capital gains will be transferred under Section 171 at a nil gain, nil loss. As Jeff keeps reminding me, this is not a relief. It is just simply the way it happens. You don't elect for it. It simply happens. So it's not technically a relief, although we do generally hear it called group relief. But it is transferred at nil gain, nil loss. And it's as simple as that. They go across for consideration for which neither a gain or a loss will arise. Now, we do, though, need to be careful if there's plans for the acquiring company to leave the group with the asset, which would be the case in a demerger, for example, that we need to consider the degrouping charges. Now, what happens when there's a degrouping event is there's a deemed disposal and reacquisition of the transferred asset at the date of the original transfer. And that then means that there is that asset then has a market value uplift, normally an uplift in the capital gains base cost. The gain is normally added to the the mechanism of collection is normally this added to the consideration on for the sale of the shares of that subsidiary. So the holding company has a bigger gain on the disposal of the shares of that company, if that makes sense. Now, normally what would happen is there's a greater gain there. It will be taxed. The company would pay the tax on the holding company would pay the tax when it pays the tax on the share sale. However, if that gain by the holding company is either subject to substantial shareholdings exemption, or the company leaves under a scheme of reconstruction, so Section 139 TCGA 1992 applies, effectively that gain is eliminated because SSE comes along and says we don't care what that consideration is, it's exempt, and 139 comes along and says we don't care what that consideration is, it's deemed to be a nil gain, nil loss transaction. So in both those situations, you would have effectively an uplift in the market value base cost, uplift in the base cost of the underlying assets to market value at no cost, at no tax cost. If I'm doing a demerger and that's the case, I will usually, because there is clearly a corporation tax advantage, I would normally throw in a Section 748 clearance transactions, corporate transaction security clearance into the clearance ladder, just to get the revenue stamp on the approval and add some comment as to why there was a transfer, there was a pre-transfer to company in the first place. Right, so there we are. Next slide, please. Right, corporate intangibles. Right, just a reminder that not all intangible fixed assets are in fact within the corporate intangibles regime. The pre-2002 assets will not be. There will be in capital gains. There's also certain assets that, I believe it needs to be within the terms of corporate intangibles for accounting purposes under GAAP to be within corporate intangibles for things. So certain things are not, like financial instruments. So things that you recognize the accounts as financial instruments rather than corporate intangibles are capital gains assets and not corporate intangible assets. So that's the first point. So sometimes intangibles were dealt with under capital gains, as in the slide above. Other times they're within the corporate intangibles regime. Now, the corporate intangibles regime has a very similar set of rules to those in the capital gain in TCGA, but they do differ subtly, and sometimes those differences can bite. So we have to be careful and check the position every time. We can't assume. Now, Section 77.5 is the equivalent of Section 171. It talks about tax neutral rather than nil gain, nil loss. That's because in its calculation, it has to take account of amortization that may previously have been claimed. So that's so 775 works in a similar basis to 171. We then have a similar degrouping concept. So if the company leaves the group with the asset within 6 years, we've got to think about degrouping. Now, here, the degrouping exceptions, I think most people a lot of people are familiar with the exceptions to the degrouping for capital gains. They are completely different for corporate intangibles, and I've seen people come a cropper with that one. I was helping with one case where, unfortunately, the last time I saw the accountants who advised on it had his PI had already paid out £1 million in tax and was expecting to pay out another $1 million. So these things can go wrong if you don't get the right thing. But essentially, there are a number of exceptions. The one we normally rely on for demerging things is 782A. This basically says that if the company leaves the group in circumstances where SSE would have applied, even if it didn't apply because it was overridden by 139, because it was a demerger, then that will be an exception to the degrouping charge. What that means is there is no degrouping event, so we don't get the tax-free uplift like we do for capital gains. So it's quite a lot there, and degrouping is always a nasty thing on all of these points, so that's why I've got a bit of extra detail. Next slide. Capital allowances. Right, I remember a few years back, well, a lot of years ago, I was looking at this. I had a case like this one, and I was looking at it. I thought, oh, yeah, capital allowance, and I just assumed the normal rules within the Capital Allowances Act applied. You know, on transfer, so the rules about succession. That was incorrect because this was a transfer within a group. I mentioned the section within CTA when I was looking at when I was talking about the losses, which covers where there's no effective change in control, in ownership and control of the company. And the same set of rules, you notice that was section 944. This is section 948. The same set of rules includes a provision for capital allowances. It basically says that if there's no change in the if there's no effective change in the ownership, the new company inherits the assets, the qualifying assets for capital allowance purposes. There is no disposal. The new company is simply treated as taking on those assets. They're actually treated on as taking those assets at the tax written down value at the start of the accounting period for the old company. And any capital allowances for the entire accounting period will be claimed in full by the acquirer at the end of their accounting period. So there's no balancing allowance. It's simply the tax written down value is transferred across, and the new company will carry on claiming capital allowances just as the old one did. And it's an automatic, and it is not elected. So this is simply the way that it is. As I said, this applies where two trading companies, certain persons own 75% of both, which is this no material change in the management, in the control, and they're both in the scope of corporation taxes, because obviously we don't want to do it. If the conditions are not met, then you can fall into the normal rules of making elections under 266 for generally, or I guess it was properly 198 elections, and such like. So yeah. Next slide, please. Stock. Right. Now, this is one which is suddenly become of interest lately, because I've had a case where I've recently been advising on a case where this became very relevant. Yeah. Right. I think most people are familiar with the general rules for stock, which are set out in the business income manual. around, stock not between connected parties is normally done by arm's length, but it is possible to make an election so that they be controlled. They can be treated as going across at the greater of cost or actual price paid. So that is the normal rules that we see, and it normally means that it goes across effectively at net book value, which is fine. However, I was recently doing a case where we were looking at several £1 million of land for a property developer that was sitting within stock, and it was a big deal. And when we looked at it, we realised that the company was large and was within the transfer pricing rules. So we had to look at the transfer pricing rules, and transfer pricing market value rules override or any claim, any election you make under 169. So we have to in those situations, it gets quite complicated. It comes out in the wash in the end, but we need to understand exactly what's going on. The first thing is that the stock has to be transferred at market value. That means that profit will be recognized in the transferor. So they will recognize the profit on that asset, on that stock asset. The acquiring company will recognize that stock at that cost, at market value. Sorry, at market value as cost. So it will come in at them as cost. But ordinarily, that company, the transferee, would not get a deduction for that that increased stock value until it sells the asset, which for property developers may be many years down the line. However, the transfer pricing rules allow the transferee to make an adjustment to claim as a deduction any increase in consideration recognized by the transferor when the asset was transferred across. So the uplift in value to the market value, they can claim as a deduction in the year of transfer, even if the item is still sitting in stock. So you see, at the end of the day, we do get an uplift we do get profits recognised over here, but then we could get losses recognised over here, which, if we're still part of the same group, and we could still claim group relief, surrender of losses, group relief. In my case, though, this action was being taken before a demerger or a planned demerger. So the question then was how can we get the necessary overlap period to surrender the losses, and there was added complications around, because you can't surrender you're treated as left the group at the point that there's an arrangement in place for you to leave the group, not at the point you're so actually the fact that demerger was planned in advance actually took away that. So we've basically had to transfer the property in advance. So the transfer of the trade is happening first before the demerger. There's going to be a period of time left over during which any losses can be transferred. So it's gotten very messy, but we're getting the right answer in the end. So if you're doing large companies, that is quite a critical point, often overlooked. Next slide, please. Other assets, right? Okay, most other assets, debtors, cash, those sort of things are simply, they've already been recognised in the balance sheet, in the P&L. There will only be, they're normally transferred pound for pound. The only way that there's going to be an impact to the P&L for those is where there's some provisions made against them. So some bad debt provisions, for example. So, but it would be the bad debt that's provided, and then it might, and then the assets will be transferred still pound for pound, subject to that provision. Liabilities, similar. They're normally transferred pound to pound because it's not an obligation. There could be a case to argue that certain loans are not valued at their face value, but that's a valuation question, and such like. However, we do have to be careful if we are transferring liabilities in exchange for if elsewhere in the transaction, when liabilities are going across, there's assets which might be subject to stamp taxes of some form, whether it's stamp duty or SDLT, because the taking on of liabilities will be seen of consideration. So it won't be possible to turn around and say it's done as a distribution. Therefore, you know, there will be it will be partly distribution, partly the taking on of debt. That will mean that taking on of liabilities might have an impact on stamp duty and SDLT positions. There might be things you can do about it, like splitting out of doing the transaction, transferring the assets in two stages. I've certainly done that before, where we transfer the properties in one stage and the rest of the assets under a separate contract. There's separate assets and liabilities under a separate contract. It is possible to work around that, but you have to be careful that taking on of liabilities is consideration for stamp tax purposes. Next slide. Right, talking about stamp duty. In theory, for those who don't know, stamp duty and SDRT can both apply to the same transactions, but if you pay one, it overrides the other. So in practice, we only really need to think about one at a time. So that's the starting position. So it's normally calculated with reference to the actual consideration paid. So if it's by distribution, there won't be anything. If there's distribution of shares, there won't be anything. If there's a sale of shares to another company, then there's for market value or net book value, then that's fine. There is one circumstance with market value, and that is on a share for share, where there's new provisions about 3 or 4 years old now that say you have to transfer the market value if it's about share for share. But and I should say, but so that's the normal position, right? Within a group, stamp duty relief would normally apply, and if you claim stamp duty relief, it wipes out the SDRT liability as well. So stamp duty relief could apply. However, sometimes even within the group, you might transfer, these things might be done by way of share for share or by way of scheme moving instructions. So it is possible for Section 77 or Section 75 reliefs to apply as well as a Section 42 group relief. In those situations, you have to decide which one do you want to use to put into your and make your adjudication. You can only claim one. As a rule of thumb, stamp duty group relief is normally claimed because it's a slightly easier test than the other, but it all depends on circumstances. I've certainly claimed Section 75 in the past instead. So yes, so that's stamp duty. Next slide, please. SDLT. Right, SDLT again is charged on market value of consideration. There is, though, a special set of rules that say if a company acquires an asset in any manner that from a related party, which another group company would be a related party, then for SDLT purposes, it's deemed to be acquired at market value. So that's the starting position of Section 53, is potentially this could be at market value. There is, though, an exception where the transfer is done by way of a distribution in specie, but that exception itself has an exception, providing in that it doesn't apply if the land has been subject as itself, if the underlying property has been subject to a group relief claim in the previous 3 years. So what that means is you can't rely on this to move assets up a chain of companies, and you need to work out other ways around it. And then the other point I've linked here is, as with other SDLT, if you're transferring a portfolio, they're going to be considered linked. So you're going to have to calculate the SDLT on the total value of the whole thing as if it was a single transfer. There is, though, now multiple dwellings relief has gone. Your options are, if it's all residential property, if it's mixed, it will be the non-residential rates. The whole lot will be non-residential rates. If it is more than if it's at least 6 residential properties, again, it will be non-residential rates. So a couple of points there on SDLT. Again, SDLT group relief might apply as it's being done within a group. However, as is the case with demergers, if the company is going to be leaving the group within, or actually no, it's a slightly different test. Is if the acquirer and the vendor are no longer in the same group within 3 years, then you could get a degrouping charge. So if the company is leaving the group with the asset, it would fall within that category. These degrouping rules for SDLT are quite complex and do need a specialist to look at. I will always get Malcolm or Marv to look at this. But the key point is that if the company leaves the group through a transaction for which stamp duty Section 75, which is the scheme of reconstruction relief, applies, then that is an exception to the SDLT degrouping charge. So on a normal demerger, if we have mirror shareholdings, then we wouldn't have a degrouping charge. If it's a partitioning demerger, it's very difficult. You cannot avoid the degrouping charge. So what you have to do is try not to incur the SDLT in the first place by transferring the properties by distribution or by some other means. So these are where my expertise come and the SDLT come. Quite, we do this quite a bit, so we sort of know a number of mechanisms to work around that, but it can be a big pitfall. Anyway, next slide I think is my last slide, and Rob is currently shaking his boots because I'm going to talk about VAT. Not my area of expertise. I will always pass over to Marv or Rob when I'm doing VAT on one of these transactions. The critical point here to note is it's normally possible to do it on a VAT neutral transfer, to do it as a VAT neutral transfer, but you need advice and you might need to do something first to do it. Like you might need to register, but make sure both companies are registered and things like that. Now, transfer of going concern is not necessarily always going to apply. I've certainly had cases where they weren't. I had one case where we transferred the assets across to a new co. New co was then bought same day by another company and all the assets were transferred up. It was all done on the same day because they didn't want to have to apply for regulation for the new co. The very fact that the new co was not carrying out the trade in the present tense because it was immediately moving it on meant that TOGC was not available. So in that case, they had to pay the VAT and then claim it back. So it can be VAT neutral, but it might mean that there's some cash flow issues. I'd also say you need to be very careful with commercial property because it has all sorts of peculiarities. I've just had a case this week where Marv was advising, and there was all sorts of things around civil engineering works on this bare land. So there was land, it was not opted to tax. Potentially they had a VAT responsibility because there was civil engineering works on it, except they weren't material, so it wasn't. It got very confusing beyond me. But I've just to say this is a complex area, and if you are looking at if the VAT is an issue, especially with land, then you need to be talking to Rob or Marv. So yeah, next slide. I think it's just questions.
Thank you very much, Chris. That was very useful. Got a couple of questions. So a couple of technical questions. The first one's on CGT reconstruction relief. So section 139. Okay.
Oh, yeah. Yep.
Yep. So one of the conditions for section 139 to apply is that the whole or part of the company's business has to be transferred to another company.
Yep.
Right. And the question is, can you expand on what it means by business being transferred? Can it include investment activity?
Right. Business. Yeah. Okay. Yeah. This is a prevalent query. It comes up quite a lot. business, we're talking more about demergers now than we are about actual transferring trades. So so it's a bit of a, but that's fine. Business in this case, it's a much looser definition than the business for incorporation relief and things like that. The revenue accept that a single property interest can be a business for this purpose. So you don't have to meet the 20 hours test of Elizabeth Moyne Ramsey, or that's not required. So a single property, it could be shares in a company which operates that business. That the business of a company is deemed to be the business, so things like that. When it comes to investments, this is one of those areas actually where I'm going to digress for a second. When you write a clearance, if I always put down what I think the tax effect is going to be in the clearance, because the revenue feel obliged to tell you if they think there's a risk that the tax won't apply, because they don't want you turning up 2 years later when the inspector raises an inquiry and say, well, why didn't you tell me when I wrote to you? So they do. So this is one of the cases where I've seen, one of the two cases where I've seen the revenue actually write back and said, are you sure it's a business? And what they basically say, it can be investments. And the revenue actually having their guidance say, provide it can be a portfolio of investments. It could be an investment business, providing that the business is actively managed by the management of the company. So if you have a portfolio of shares sitting in with a broker and they're doing all the work, you won't be seen as being carrying on a business for 139 purposes. However, if you have got a number of investments held directly by the company or in a portfolio where you actively manage them yourself, so you decide what to buy and sell, then that could well be considered a business. But it is something that needs to be considered. If you have got those sort of things, you do have to be careful that not everything counts as a business. So good question.
All right, thank you. The second question is about loan relationships and exemptions from the loan relationships. So the question is about a degrouping charge. Have you ever seen a degrouping charge be disapplied because of a loan relationship exemption, or because it's within the loan relationship rules?
No, yeah, there are some complex loan relationship rules. I suspect we're talking about the connected company rules here.
Yeah.
Yeah, we're normally talking about companies that stay with that remain within connected companies. So in practice, when we're talking about within a group, I haven't personally seen it because the loan relationship. I have to be honest, I'm not the loan relationship specialist. We have a treasury expert, David Porter, who does that. Yeah, I'm aware that if they cease to be connected or they become connected, you have to recognise things. But yeah, they can be. I mean, normally when I tend not to see these coming in on the cases I do, although I am aware that if the companies cease to be controlled by the same persons, then there can be an adjustment depending how the accounting and tax has misaligned whilst the companies were connected. If that makes sense.
Yeah.
So it might be that the future, what you allow you to is, to the extent the debt has gone down in value whilst the company's been connected, you can't get a deduction for that drop in value afterwards. So that's effectively what would happen. So it restricts any adjustment to what was the market value of that debt at the point where they cease to be connected. So the company leaves the group. So yeah, so it is quite complex area. But yeah, if there's a specific point, we can look at it.
Yep. Thanks, Chris. Okay, and then I think that's all for the questions. Excellent. So I just got a couple of reminders for everyone. The all-day TSP conference, that will be held on Thursday, 19th June, so in a couple of months. TSP clients will hear from us shortly about registration. And I look forward to seeing you all in the next TSP webinar, which will be around mid-May. And invites will be sent for that next week via email. And we'll also send a copy of this recording by email next week, along with the slides. So thanks everyone for listening, and see you next month.